Hello everybody and welcome to the market briefing for Sunday, October 9th. Alright, just before we get going here, a quick disclaimer. Everything we do here is for educational purposes only. We are not investment advisors and do not provide investment advice. All trading and investment decisions are your own and done at your own risk. Alright, get that out of the way. Next step, go hit that like button. You know what to do. All right, let's take a look at what we've got for earnings this week. And you might notice that as we get into the end of the week, the earnings calendar starts to fill up a little bit. That can only mean, and if we look at Friday, we see a bunch of big banks, and that can only mean that earnings season officially starts later this week. All right, so yeah, early in the week, really nothing there that's interesting at all. But man, we get a bunch of interesting stuff on Thursday morning. Before the open, we've got Taiwan Semiconductor, we've got Delta Airlines, we've got BlackRock. You know BlackRock, they make tons of ETFs, and they own kind of almost a little piece of everything. We've got Domino's Pizza, we've even got some of these other smaller ones down the list, but I mean these four here, and it's really interesting because they are big companies that represent big industries, semiconductors, airlines, financials, non-bank financials, food. Domino's is a monster, right? So Thursday after the close was nothing. But then Friday before the open, we've got JP Morgan, Morgan Stanley, it was Citibank even, United Health Group, is the one here that's not a bank or not a financial. Lots of interesting stuff going on in the earnings candle towards the end of the week. All right, let's take a look and see what we've got on the macro calendar. So tomorrow on Monday, Canadian stock markets are closed. It's Thanksgiving here in Canada tomorrow. We have ours early, so happy Thanksgiving to all my fellow Canadians. In the U.S., it's Columbus Day. I believe it's still called Columbus Day, although that may be changing soon. And don't cancel me if I'm wrong. Just let me know though. So U.S. markets are open for Columbus Day, although bond markets are closed tomorrow. But equities markets are open, and futures markets, as far as I know, are open tomorrow. There isn't really any economic data coming out tomorrow. It is a federal holiday, so the government isn't releasing any data or anything like that. On Tuesday, also tomorrow actually, we have the IMF International Monetary Fund meetings start, and I believe they continue all week long. So we should probably expect some statements and a little bit of news coming out of those, and that could be fairly important. It is important to the global economy what goes on at this meeting. So that is kind of the highlight on Tuesday, is just that the IMF meetings are continuing. On Wednesday we have PPI, Producer Price Index, an important inflation metric. So that's on Wednesday. Also, another really important event on Wednesday, the FOMC meeting minutes from September. So we get to look inside the Fed's meeting a little bit, find out why they raised rates the way they did, how they see things going forward. I think we all have a pretty good idea of how they see things. But occasionally there are little surprises in these minutes. So the market does pay attention. If there is a surprise, if there's something in there the market doesn't expect, the markets will absolutely react to that. So we need to pay attention on Wednesday. I think they come out at 2 o'clock. I'm not totally sure. I'll post that in the morning briefing on Wednesday. I'll be posting the time that's coming out. On Thursday, as if we didn't have enough going on Wednesday, we have the CPI number. So again, this is the inflation report that everybody in the media and all participants in the market look at. The Fed says they don't watch it so much. They prefer the CPE, or sorry, PCE, personal consumption expenditures. They prefer that to the CPI. But the CPI will move markets. There's no doubt about it. And maybe it's already been moving markets. Maybe what we saw on Friday was about the jobs number, really, but that jobs number going into Thursday's CPI report was probably one of the reasons that the market was down so much on Friday. I think, if CPI was still a couple more weeks off, I don't think we would have been down quite as much on that jobs number, although it was not a good jobs number for the market. Great for the economy, but not good for the market. Okay, what else we got on Thursday? We've got, as always, unemployment claims, and we also have oil inventories. Now, I haven't mentioned oil inventories before, crude oil inventories in the U.S. I haven't mentioned that before. It also happens every Thursday at 1 o'clock. Oil is just becoming more and more important, and it can affect the market as well. But oil and energy trades, the energy complex is kind of the one trade that's working through all of this. So I think that, oil is, if you're trading, if you're swing trading, oil is something you want to know when these oil inventory reports are coming out. And then on Friday we have retail sales, and we also have U of M consumer sentiment and inflation expectations. So a fairly busy week. Not busy to start at all, but once we get to Wednesday, it gets a little crazy from there. There's a lot of big stuff coming later in the week. So we're probably going to spend Monday and Tuesday preparing for all this stuff. All right. Let's move on. So we're going to take a look at the markets. We'll start out, as always, with the major indices. We'll look at some important commodities. We'll look at individual sectors. And we'll see if there's any setups. And believe it or not, I do have a couple of setups. I was a little reluctant, but I don't know, they just look good. So we'll take a look at those towards the end. All right, let's move over to a daily chart of the S&P 500. And you can see we're still firmly in a downtrend. We had a nice bounce really nice bounce on Monday and Tuesday, and gave almost all of that back on Friday in one day. I do want to point out, I don't know why eSignal's data is bad on these candles, but this candle here, there's no wick on that candle. That day, and I mentioned this on Wednesday as well in the video. But this day it opened and just went up. And then on Friday, there's basically no wick on that candle too. If we look at an intraday for Friday, you can see, actually here, let me go to a 5-minute on this. If we look at Friday, you can see we opened and just went straight down, right? So no upper wick there, and yet eSignal is showing that as an upper wick. And so what this is doing is it's hiding a chart pattern here that I think is quite important. And that chart pattern is an island reversal. When you have, a few days or even weeks of price action just sort of off in space here, and then you gap down, that's called an island reversal. And it's generally not a good thing, unfortunately. So, and we'll see actually quite a number of these as we go through some charts today. We did on Friday, the one thing that sort of gives me a little bit of hope for tomorrow, we did manage to close above that June low. That number has been so important. We didn't crash down all the way through, this low, right? It's ever so slightly bullish. I'm clutching at straws here to find something positive in all of this, because it really doesn't look good. At least we did close above that June low and above most of this price action, right? It's pretty much on that low from that day. So, it could be a reason to bounce. I also want to point out that, last weekend we talked about the RSI divergence. and how that could lead to a move up. And that's exactly what happened the very next day. Had that really nice day on Monday and Tuesday. So again, we want to keep an eye on these divergences. But there's no divergence here yet, right? We're not going to know unless we make or make a lower close in this close whether or not this is going to be a divergence or not. I suspect probably not if we come back down that far. But so that's our SPY. Oh, I want to go to the weekly on the SPY because a lot of people are talking about the 200-week moving average. I think I brought this up. Did I bring it up in the last weekend video? Here, just let me compress this and bring some more data in. Okay, there we go. I can see that better now. So you can see that this 200-week, this orange line here. This has been fairly important a number of times. It has acted as support and resistance in the past, as you can see here. It definitely acted as support in 2016, again at the end of 2018, when we had that very brief, very minor bear market there. Didn't really hold up much through COVID, but we are right on that moving average right now. And people are attributing a lot of importance to this, probably too much, but it is what it is. What's more important to me is the RSI divergence in this one as well, and it is still there. Here, let me get this and show you. So you can see that we had a low here, and we had this low here. Okay, and we have our low in RSI. We have this low here, which is lower than this low, but we've made a higher high, or a higher low, sorry, in the RSI. That's a bullish divergence. Now, this is not a pretty weekly candle. This weekly candle is green, by the way. You wouldn't believe it. After Friday, you wouldn't think that we'd have, the indices finished green on the week. I was a little surprised when I noticed that because it certainly didn't feel that way. But that's what happened, right? See, we did close higher than the close of the following week. But this is not a pretty candle. This is not bullish at all. However, we are right on this 200-week moving average. It is holding. We've got this RSI divergence. So if you're really looking for something to clutch on to be bullish, there it is. All right, let's move over to the Qs. They're going to look very similar to the S&P 500. Move over to a daily chart here. Holding up a little, holding up again below that June low, or I guess almost right on it, and the support area here. Important to see that, but not looking terribly healthy. Not looking, and again, you can see that it's easier to see the island reversal on this one here. This looks like it's going to be more downside. We've got support just below, and I think we've got to go even farther back in time to get more support. I haven't put them in yet, so yeah, we'll see what happens when we get down to this 262 area, if we get down to the 262 area. Okay, IWM, Russell 2000 small caps. This index is outperforming, and small caps in general are outperforming. A lot of what we've been seeing, especially on Friday, was a collapse really in large cap tech. But the small caps have been holding up better recently than large cap tech, and even better than the S&P 500. And you can see that on Friday, this grabbed support from that May low, and the top of this sort of consolidation range here. Still a little bit of an island reversal there, but we're well off these lows, right? We have the June low down here, and we managed to stay off that June low in this consolidation, and we're well above that. So this is interesting, and I want to show you a relative strength chart on this. Okay, so In the top chart, we have IWM going back to the middle of 2021. Okay, and this red arrow here is you can see where IWM topped out, and this was early November of 2021. Okay, and IWM started going down from there. And and I mean, it's still very much in a downtrend. I mean, don't get me wrong here, but just be aware of. I just want you to, for now, be aware of where this high is. And the S&P 500 didn't top out until beginning first trading day of January. I think it was the first day. Second trading day of January of this year. So a couple of months behind IWM. And that's fairly typical in bear markets. Coming into a bear market, the small caps, the most speculative stocks, are the ones that are going to be sold first. Okay? So you can also see, while we're looking at these top two charts, so in the top on the IWM, you can see where the low, the 52-week low is. Made that 52-week low in June. That was the June low. Okay, S&P 500's 62-week low was just recently, at the end of September. But you can see that the IWM did not make a lower low there. Okay, another little interesting tidbit. And then finally, I want you to look at the bottom pane. So this is IWM relative to the S&P 500, and you can see from here where IWM topped out and started to really underperform the S&P 500. We have this steep downward line, and then we kind of started to go sideways a little bit. And when we put right here in May, so even before IWM put in its 52-week low, back in May, this relationship of IWM to S&P 500 put in a low. And you can see that it's been trending up since then. And I've drawn that trend line underneath. We have put in unfortunately, I mean, we've almost got a bit of a downtrend here, okay? I've marked in that pivot high from August. And we have put in a lower high and a lower low since then. And we came up and we tried to put in a higher high just recently, and have not been able to do that. Now, I'm going to say here that as long as IWM, the Russell 2000, is holding this uptrend line, and even better, if we can come up and put in a higher high now, I would be getting much more bullish and really starting to look for signs of the bear market ending, because the Russell 2000 was the first one to show weakness. It should be the first one to show strength. Now what we're looking at right now, there's no reason to go out and jump into small caps or anything like that. But it is something that's worth watching. It's worth keeping an eye on. Now, if you're using TradingView, you can come up with this chart on your own. All you got to do is type in the two tickers, so IWM and a slash, divided by SPY. And so when that relationship is going up, IWM is outperforming the SPY, and when that's going down, IWM is underperforming SPY. And it's good to look at these, I'd like to use these kind of relative strength charts, when I'm comparing a stock to its group, its sector or subsector, or when I'm comparing a sector to the S&P 500 or another index. So yeah, these kind of charts are really handy to sort of give you an idea of what's going on and where strength or weakness is. All right, let's move on to the volatility index. Get that back there. Okay, so you can see, over the last couple of days, volatility's moved up quite a bit. We've left sort of that downtrend line in there, and we can see that acted as resistance today. Or not today, on Friday, sorry. Actually, I was listening to a podcast yesterday, and the way the guest described the volatility index and where the volatility index right now, I thought was really amusing and a great analogy. He said, what we've seen in the volatility index, with volatility pretty much being between 24 to 32, even up to 35 or 36 over the last many months is kind of like a Hitchcock film where you're always in suspense. Throughout the entire film, you're always in suspense. You're always a little bit scared. But it's not terrifying. And he suggested that what we need to see happen is that we need to be terrified for the bear market to come to an end. It needs to be terrifying, and it needs to be terrifying like a teen slasher movie is terrifying. Well, all of a sudden, it's like, no, don't go in that room, and somebody jumps out of the corner with a chainsaw or whatever, and you jump, and it's terrifying, but it's quick and it's over, right? Well, that's what when VIX goes above 40. That's what happens. It's terrifying, and it terrifies the markets. You get these, you can see here, right? Here's 40, 42. When you get above that level, it shoots up there really fast, and the market just crashes. It capitulates. He suggested that's what we need to see to put an end to this bear market. I don't know if I'm convinced of that part, but I loved the analogy so much. So the market, the way it is right now, it's kind of like that Hitchcock film where you're always a little bit afraid. It's always suspenseful. You're not exactly sure what's coming next, but you know something's coming. And I think that's where we are. All right, let's move on to TNX, the 10-year yield. And we can see that this is still moving up here. We'll zoom in a little bit here. This is still moving up, and interestingly, that former uptrend line, this uptrend line that was so clean on the way up, is now acting as resistance. Still going up, of course, but acting as a little, resistance. This isn't moving up very quickly. We don't have any big bars right now, so that's good to see. If these were really big bars, this market would be even rougher shape, I think. However, we are coming into that really important 4 level fairly soon. It'd be really nice if we get there. It'd be really nice to see that act as resistance and this roll over again. Probably won't get what I want to see, but that would be the ideal situation for that. All right, let's move on to the dollar index. So you can see this had, and right at a little bit of a minor support level, had a nice tweezer bottom on that pullback. And I say nice because usually when you see something in an uptrend like this, you have a pullback and you see this pattern right here, right? Big red down bar, big green up bar. They share the exact same bottom, and these two bars, these two candles, are almost exactly the same size. This is a beautiful reversal pattern. You ever see this in your stocks, you kind of want to be adding more to your position on something like this when it's in a really nice uptrend. Or even it does make a nice reversal pattern in a more serious downtrend as well. Now in this situation, in this context, we don't really want to see this because it is quite bullish, and we don't want this dollar going up. With the dollar going up, U.S. equities are going down, international equities are going down, the world is having trouble, currency markets are getting into trouble, central banks around the world are getting annoyed. The UN is getting annoyed with the U.S. and how strong the dollar is. It's just not good news. So again, just like with that 10-year yield, we'd really like to see this roll over, ideally before it even gets up here. But if it gets up here, we'd like to see that act as resistance. Here, let's just draw in sort of an area where we want to see that happen. All right. So where do we go from here? Let's take a quick look at gold. So gold and silver had a really nice move up, and stalled. Gold here stalled right out of the 15-day moving average and rolled over. However, on Friday it found support right at the 21-day moving average. It would be kind of fun to see this set up a squeeze. If we start to move up a little bit more slowly and squeeze right underneath the 50-day moving average, and above the 21-day moving average. I could set up a nice little play there if you're so inclined to be playing gold. Let's see, silver. Silver might have kind of a bit of a bear flag. It's a little messy. It's a little volatile in there, but it might be interesting to watch this and see where it goes as well. Copper. So yeah, last week we talked about this. We talked about how it had a nice move, or was starting to turn off the bottom here. Made a nice channel. But we were talking about how it's coming up into a confluence of resistance there. You had this former uptrend line. You've got a support resistance line there. The 50-day moving average. It really looked like it was going to fail in that area. And sure enough, it did. Pulled back quite hard on Thursday. Pulled back some more on Friday. So it'd be interesting to see, does this find support here? And we could look to this pivot level right here. In fact, let's just draw that in, make that a little more clear. Got a bit of a pivot there. And we're right on top of that now. That would be a logical place for it to turn if it's going to. If not, I think it's reasonable to say that this is going to come all the way down to the bottom of the channel again. So that was copper. Now, things get interesting when we look at DBC, the overall commodities index. And as you know, we've been in a downtrend for a while. We broke out, or broke down below an important support level. And fairly quickly took that back. It took a week, but this is an intermediate term pattern here, right? This whole pattern is now over 4 months long. So taking a week to get back into its zone is just fine. And once it got above that support resistance line, well, you can see the kind of strength it's had since then, and it broke that downtrend line. So this is really interesting. Things are getting very interesting in this space again. However, we've got some resistance overhead, and we've moved a lot, right? I'm not sure what that is on a percentage basis, but it is a fairly decent move. Okay, this is, almost 12%, which is a decent move for this ETF, right? 12% is a decent move for almost any ETF. So I would not be surprised for this to find some resistance up in this area. I don't think it's going to make it all the way to this pivot before it starts to go sideways for a bit. We even roll over a little bit for a little bit of a pullback. But yeah, I think we can expect some consolidation, maybe a minor pullback here, and then continuation higher on this one. Whew, it's getting really warm in here. Okay. DBA, the agricultural commodities ETF, that is still inside this bear flag. It's been well over a week since we talked about that. I think a week and a half since we talked about this bear flag starting to form, and it's still in there. It's getting down near the bottom of it. Whichever way this breaks, it's probably going to move a fair bit once that breaks. Crude oil has made a fantastic move. And this is why that overall commodities index has moved up so nicely as well. And you can see that crude oil is also broken out of its downtrend. It's broken out of this downtrend channel very nicely, very strong. And it was strong again on Friday. It's now coming into an area of major resistance. And we've got the 200-day overhead. We've got the 100-day overhead. We should be looking for consolidation in this area, and consolidation would be healthy. Let's see how far we've come off the bottom. Yeah, we're 21.5% off the bottom in 2 weeks. That's a decent move. This is allowed to take a rest. So I think without me even drawing it there, I'll draw it anyway. But I think you all know kind of what I'd like to see out of this. I'd like to see a consolidation, either under the 200-day moving average here, or under this resistance line. Go sideways for a bit, maybe not that long. You know, 2, 3, 4 days. Consolidate in here and then break out higher. And I see no reason why it can't do that. You know, we've got OPEC now is going to be, or claiming they're going to cut production. They have cut back their production quotas. So you know, we'll see where this has to go. You know, Biden retaliated by saying he's going to release another 10 million barrels out of the SPR, but that had no effect on the price of oil, as you can see on Friday. All right, natural gas. Still a little bit of a downward move here, kind of a downward sloping bear flag, and you know, we don't like to see, you know, if we wanted to play this, if we want this to be bearish, we wouldn't want to see this sloping downwards. A bear flag that slopes down is prone to failure, just as a bull flag that you know, slopes up is prone to failure as well. So failure in this case means that this should break out to the upside, and I'm a little surprised it's not stronger with oil, but you know, that is what it is. Okay, let's see. XLE, the energy sector ETF, very strong, right into resistance right now though. You know, could go a little higher, maybe goes up to this pivot, but again, you know, this has such a nice move. Let it take a break for a few days. Let's go sideways for a few days. Build some strength for another move higher. XOP, oil producers and explorers. Again, right into resistance. No reason why you know, this can't go sideways. Have a nice, healthy sideways consolidation and then break higher. And we're going to see very much the same thing in the oil services ETF. Again, into a resistance level after a really nice move. Nothing wrong with it going sideways. Now TAN, the solar ETF, on the other hand, this just continues to break down. And I think part of the problem here is it just cannot, whereas oil is so strong right now, that the companies, the stocks within that sector are able to overcome this weakness in the market. I think what's happening in the solar stocks is a lot of these companies are a little smaller. A lot of these companies have had trouble over the years, and solar is just very volatile. It's maybe even be more volatile than oil and the rest of the energy sector. But you know, once this lost this support level here, I mean, it was almost doomed, right? And you can see, you know, it came down, it tried to go back up, and it couldn't even get all the way up to that former support, and has rolled over again now. So this is putting in this is definitely starting to put in a downward channel here. So actually, this can give us an idea of what we might see moving forward here. So yeah, I mean, if this channel line is going to work, we've got, you know, more downside probably down in the 68 area. Where you can see we've had some minor support in the past, and maybe we see it turn up there. You know, this chart, TAN, is so volatile and so messy. I'm almost reluctant to put any support resistance levels on here, but yeah, that level around 68 looks pretty good. But you know, as you can see, also, I mean, this can go through these levels quite easily. Okay, so that is the solar ETF. First Solar is one, you know, this is the leader in this sector. It's had relative strength, and you know, it hasn't completely rolled over yet. It has been weak the last few days. It's trying to find support at the bottom of this range. We should probably move that down just a bit. There we go. That looks better. We really need to see a bounce here, and you know, move back up. Another one of the leaders in this space that is now showing a fair bit of weakness is ENPH. You know, this had put in some nice consolidations here, But unfortunately, the last two of those consolidations has broken out to the downside, and you can see that I've drawn in a little bit of a head and shoulders. Now it's a very kind of narrow head and shoulders. They're usually a little more dramatic than this. But yeah, I mean, this does look like a head and shoulders. It's breaking down like it's a head and shoulders. So target on this breakdown brings us into the 230 area, and that's just above this support zone, or former. It's just above this former resistance zone. So I wouldn't be surprised to see that act as support. And there's also actually a gap in here. I should probably draw that gap in because I think that's going to come into play. So that gap goes from here to there. And yeah, so you can see we've got, I think it's pretty reasonable to expect this to come down into this area and then probably bounce from there. So probably more weakness ahead for Enphase. Okay, let's quickly go through some of these sectors. They're all kind of ugly. So this is consumer discretionary. You can see that this is definitely in a downward channel. Bit of a double bottom, or sorry, a potential double bottom here. It's not a double bottom until we move up from there. But yeah, I mean we would be talking, if this did move up from here, we would be talking about that as a double bottom. Or we come down. We do have some support here. Doesn't look terribly strong, but we'll have to see. Industrial had been outperforming a little bit. Still are, I guess, but had a couple of really bad days. Looking at this, maybe, we did finish off the lows on Friday, so that's good. That's a positive. And we should be coming into an area of support here. So, maybe we do see a turn there. Financials have also been quite weak the last couple of days, although they're still off that cluster of lows. I think it was IWM was looking kind of like this as well. So this should be fairly strong support in here in this 30 area. Or above 30, sorry, 30. Schwab is one of the financial companies that we've been watching because it's had this nice consolidation in here. It tried to, it gapped up. That gap is now pretty much closed on Friday's move down. But this still does not look bad, and it's still, we've got this rising 50-day moving average. It's bounced off of there before. We've got the 21-day moving average just below. I could very much see this turning back up again. And this could lead the sector higher. So I think we shouldn't take our eyes off of this. XLK, the technology ETF. You can see clearly have an island reversal in that one. You can see all this surrounded by all these gaps. Should probably draw those gaps in. We've got the gaps there and here on the way down. So yeah, very gappy in there in technology, very near the lows, and these lows are below the June low, of course. If we look farther back on this, we see some gaps going back into the past, but we don't really get into a major support area until we're down in this 110 area. So yeah, this could fall a little bit farther, another 9% or so. Communication sector, again, quite weak, very near that cluster of lows, which are well below the June lows. Again, not looking healthy here. What we're seeing here is not terribly hopeful, although we did have kind of 1, 2, 3, 4, 5, 6, 7 lows, consecutive lows in this area. Should be fairly strong support there. Let's see, where do we got to go back to yeah, there's not a lot of support below this until we get down to about 45. So we don't want to see that happen. Meta, what a piece of junk this thing is. It has broken down again. I put in a new low on Friday. I've backed way up in the chart now. You can see where I have this COVID low in purple. I've had to back way up into a chart where we've got low back from 2018, the end of 2018. And also this area here way back in 2016. So we're going way back in time to, looking for areas of support for this thing. So there you have it. A test of that, 2016, 2018 support area. Looks like it's in the cards for Meta. Apple. So, Apple firmly in a downward channel. It did recover reasonably well from this break out of the bottom of the channel. Got itself back up okay, but unfortunately, it didn't get all the way back to the top of the channel. So does that mean then we've got to think about an accelerated down channel here? Is that what's is that what we're seeing? If this doesn't bounce off the bottom of this channel, tomorrow or the next day, if this continues on down through the bottom of the channel, then we've really got to consider the possibility or the likelihood that we're going to see an acceleration to the downside here. It wouldn't be too long then before we saw a test of this June low, and we certainly don't want to see that. It's just too much risk that breaks. If that breaks, then that may very well trigger the capitulation that a lot of people are expecting in the market, which would take us a lot lower in a lot of stocks and the indices, of course. All right, so let's draw in what we do not want to see. So an accelerated downtrend would look something like this, and we'll just sort of drag this over. That even almost fits too well, doesn't it? This is the new channel we're going to be watching on this. Hopefully, we can turn up from here. Netflix, it was, kind of hanging in, trying to break out of this range, has broken out of the bottom of that range. Broken out of the bottom of part of this range. We've got this huge range, right? And we've got a bunch of smaller consolidation ranges within it. All of which tend to have, kind of have half decent moves coming out of them. But what it hasn't been able to do is break through this sort of 251-ish area and really go attack this gap. And you can see that on Friday we had quite a move down and fell out of that consolidation. Now, I suspect that on Netflix, we've got a lot of potential support here. There's that little pivot right there. Then we've got the lows of this range. I'll just drag that across. So again, we don't have to panic yet in Netflix, but it does need to bounce. Let me just move that up just a bit. There we go. It does need to bounce off some of these lines soon. We do not want to see it break below this lower line here. Where we've also got, just below that though, we've got the 50-day, we've got a Keltner channel and the 100-day moving average just below. But no, we really need to see the support hold here, and maybe it's got to put in another consolidation down here before it's ready to go up and attack this. But Netflix is one of those companies. It's a good company. I don't see this being beaten down for forever. And it has been beaten down so much. But this is a company full of imaginative people, full of innovators. This company has been an innovator right from the start. They are beaten down now, but over the long run, I'm very confident that this will come back. Maybe, I don't know, maybe I'm burying my head in the sand. Maybe there's something going on that I don't know. But, I think over the very long term, I see no reason why we can't in the next couple of years see at least a double out of Netflix. But that's not investment advice, by the way. and it's not ready to go yet. There's no entry here yet. The entry is when it can really break out with conviction and momentum and get into this gap. All right, so Google, more weakness, but it is still above those lows. That's important to see. But we just this bar on Friday was just so weak. Don't want to see that. Microsoft, again, big company showing a lot of weakness. Look at this. I mean, look at this giant gap down, huge move down 5%. What was the Qs were down? Oh, Qs were down almost 4%. But this even number underperformed the index on this giant gap. Let's get that in there. It's probably going to act as resistance on the way back up, right? It fell right below what should have been a support area. It gapped down to below what should have been a support area, and it didn't find support until that pivot. So let's get that in there as well. Okay. So, does it find support here, or does it go lower? And if it goes lower, where are these lows coming from? Where have I gone back here? I've gone back into late 2020 to pick up this level. Our next level below that is probably around, so this is 228. Actually, we should have a level here in around 210, and then 200, obviously. Going to be an important level if it starts to break down. So you can see a lot of these big companies. These are what should be the stalwarts, right? Are really looking unhealthy now, and this is sort of frightening. But it is also, this is again typical behavior of what we see towards the end of a bear market, where those big stalwart companies, those stocks that everybody has in their portfolio, those are the last ones that are to really let go and really capitulate. So again, as bad as this all looks, it could mean that we're getting close to the end of this bear market. All right, where do we go next? Let's see. Let's take a look at Tesla. Or not. Where did Tesla? I lost my Tesla. Ah, there we go. Okay, Tesla, yeah, another big company everybody loves, everybody has in their portfolio in one form or another. If you've got an index, you've got a lot of Tesla in it. Totally breaking down here. Part of this is to do with Twitter. Part of this is their production numbers, their delivery numbers, and part of this is the market. This is not good. I mean, this is just falling apart. How much are we down now in 2 weeks on this? Or I guess the last 3 weeks. 30%. 30% since this move down started. That's brutal. Oops. Okay. Well, you can see where support is. The support starts coming in around, probably in around the 210 to 206 area. If this were to come down even farther than that and then break 200, you can see it starts getting really thin under there for price action. So we definitely don't want to see that. We need to see Tesla find support soon. But it looks like there's more downside ahead for it. Okay, we have next Semiconductors. So Semiconductors not looking good either. Had a terrible day on Friday, put in that same island reversal thing, but still above these lows, unfortunately below the June low. AMD, we should look at AMD. So AMD had a nasty day on Friday, down almost 14% into major support. This 59 level going back to this consolidation back in mid, or actually, yeah, the post-COVID consolidation, and also the support and resistance really comes from pre-COVID in early 2020. And then it continued to consolidate in that area post-COVID before breaking out and going higher. Now, that 59-ish, 60 level, very important. It held there on Friday, but it closed right on the lows. It does not look good for this for tomorrow. However, this 50 level, I mean, who's not gonna want to buy AMD at 50? I know I do. I mean, I'm thinking about it now, and I'm refreshing all of my fundamental analysis on this. I'm refreshing my thesis because I think there's really strong potential for a good long-term hold in this. Like, I just can't see. I can't see over the next 2 years AMD going back up to at least 100, 120. That's a double from here. If we do get out of 50 or near 50, like I suspect we're going to, 100, a double is a no-brainer. So what I want to do, and what I'd really like to do in this is play it with leaps. Very long-term options with at least 2 to 3 years. I haven't looked at the prices of these yet because I know they're expensive. I know that implied volatility in AMD is going to be very high, and we can look at that. I've actually got that set up for you. So if we go over to Market Chameleon, and we can look at the IV30 rank, the implied volatility rank on AMD, and it says 91%. So this is telling us that 91% of the time, volatility is lower than it is now. This is the worst possible time to be buying leaps in something like AMD because they're going to be extremely expensive, and you have to fight all this volatility on the way back up because that volatility is going to come out of it when it goes back up. So what I'd really like to see happen in AMD, for me to be able to buy leaps, basically, I never want to buy leaps when IV rank, is above 20. 25 is kind of my max, and if I really, really want something, if I really think it's going to move, I'll go to 30. But I won't touch leaps with an IV rank above 30. It's just too much headwind in them to be playing with that. So what I'd really like to see here in AMD is for us to maybe come down into this 50 area, but support there and go sideways for like a month, maybe 2. Really tight sideways consolidation like this. And if it did that again between 50 and 59, this would be great. And IV, all the implied volatility would spill out of it. It would all bleed out. Those leaps would become much, much less expensive. And I think that would be an excellent trade if all that comes to pass. If you buy the right leaps, if you were to buy, say it was in this 50 to 59 area with low volatility, if you were buying leaps that were say $70 leaps, maybe $75 leaps, they're not going to cost you a ton. And if this does double over the next couple of years, goes to 100 to 120, those leaps are going to be worth a small fortune. So I think that we need to keep an eye on this. We also need to be really patient, right? Obviously, I think I've expressed that. This is something to put on your radar. And I think it's something that we're going to be watching over the next little bit. Okay, let's move on to healthcare. Healthcare not looking pretty, long-term consolidation really, but it looks like that's threatening to break down. So we do have some support in this area. I should have that line in there. Where are we here? Yeah. Right about there. So yeah, we've got some potential support here. We've cut through there before and bounced right back up again. So maybe if we cut through again, we'll bounce right back up. But again, healthcare is not really my favorite space. However, biotech, biotech is showing relative strength, not only to healthcare, I think, but also to the market in general. Biotech is kind of an area we want to keep an eye on. However, we're still watching this head and shoulders, potential head and shoulders top here. Because it did, we broke down out of there. We didn't get anywhere near the target. We moved back up. We could not break back through the neckline. Look how clean this has played out, right? If you keep an eye on this, I don't know, take a picture, take a screenshot of this, or mark it up on your own chart, because this is classic head and shoulder behavior. Right, a little bit of a slope on our neckline. It's nice. It's reasonably symmetrical. We break down, we come down a ways, we start to move back up, and just the way the neckline is perfectly acting as resistance. And you can see on Friday we rolled away from there. Now, if this is going to play out like the TA says it should. This should come down quite a bit further and come down and hit this target down in the 67 area. That's a long ways down, and I think that for that to happen, the market is falling apart, unfortunately. All right, let's move on to REITs, another disaster area. This is probably the worst sector right now. I'm being a little subjective on that. I don't know that for a fact. It's something actually I'll look at before Wednesday. But just looking at this chart, it looks even worse. It almost looks worse than communications and technology, right? Really fell apart on Friday after, couldn't find any support there. Gap down, went lower. Now you can see that we've got a major support line coming in at this 3380 area. Supported in there post-COVID. That line also comes from pre-COVID, going all the way back, actually, kind of going back over here in 2016, right? But you can see we had a consolidation in that area. So in a way, this is sort of similar to what AMD is doing, going back and retesting some really old, really important levels. So it'll be interesting to see what happens here with REITs. If this level supports, it should. Right, it was a pretty strong resistance level, and it became a reasonably strong support level. It should hold. If it doesn't move all the way down to, maybe 32 could hold, but probably 30 is looking a lot more likely on that. Should this break down, and it kind of looks, just looking at some of the weakness. However, though, actually, I just noticed. I should have noticed this before. We have an RSI divergence here. So you can see we've got much lower close here, and that's a reasonably higher close on the RSI than when we were back here. So that's interesting. That is definitely something to watch for in this. Oops, that's not the one I want. That does signal. There we go. That does signal the potential. Oh, why is that green? Anyway, for this to maybe come down a little bit more and then bounce off that level. So yeah, I'm more confident about this support level at in around 34, 3380. I'm more confident that is going to hold, but really just based on this RSI divergence. Okay, let's move on to staples. We're getting near the end here. Sorry, I know this one's running a little bit long, but there's just so much going on in the last week, and a lot of important stuff on these charts. Staples, again, very weak, and I know I've said this before, but these are other areas that are kind of the last ones to let go in a bear market. These are the defensive areas. These are it's supposed to be these safe places for your money. And obviously not safe. When we start to see these break down, when we see these capitulate, that almost always signals the end of a bear market. And we are definitely seeing almost capitulation-like action here. Don't have the volume quite yet, but you know, this could move down more before it gets to you know, an area of support. You know, this actually probably, you know, this 63 area, probably major support there in the staples. Now utilities, the most defensive of all sectors, and it has been falling apart. It has broken down through this uptrend, and looks to be continuing down. We've got some minor support there. We're not going to get into a major support area until we're way down into around the 54 area, another $10 down here. But you know, so as you see, I mean, almost everything in this market is falling apart. All right, two more setups actually. Yeah, we've got a couple of setups. Now, I was reluctant to even mention these because these setups, I think, really require the market to be green tomorrow, or to reverse tomorrow and move higher, if they're going to work. Now, they could just go sideways and stay intact as setups, but they wouldn't be playable until you know, we get a breakout. Now, both of these are breakout setups to the upside. Okay, so the first one is Robinhood. And I just want to be really clear here. None of this is investment advice. I'm just pointing this out, educational purposes only. And if you decide to play this stuff, be super careful, because you know, you're going against the grain here. You're being contrarian, playing a breakout in this market environment. Okay, and I think you can see why I'm saying that we need the market to be going up. We need the indices to be going green, and people to be in a buying mood for this to work. But I think that if this worked, because this has been showing relative strength now for 2.5 weeks. Friday, you know, what did it go down? It went down, 3.5%, but that's not much. That's not much in Robinhood, because Robinhood's a very volatile stock. You know, look at our ATR on Robinhood is over 6% a day. We can expect plus or minus 6% in a day in Robinhood, and on Friday we got 3.5%. So I'm not at all concerned about that red candle. Look, it's kind of indecisive, right? It's a bit of a doji. It's an indecisive candle, and it happened right under potential resistance. We've got this 200-day moving average that it's sitting right underneath. So I think here, a couple of days of consolidation would be ideal. But if we get a green market, if the market's looking strong and this breaks out of here, it could make a really strong move. And you notice this rounding bottom pattern here, or this saucer pattern, some people would call it. I think this thing could really go. You could get 2, 3, 4 days. You could get a short squeeze going on. What's the short interest? Oh, it's only about 10% or less than 10% short. That surprises me. This could have a strong move. Certainly up to 15. There's nothing between here and 15. And maybe even a little higher than that. Maybe even up into the 17 or 18 area. So keep your eyes on this one, but very risky play. Tight stops, right? If you play it, tight stops. Peloton. Another super crazy risky stock. You guys are probably shaking your heads at me not recommending, but even bringing these kind of stocks up. But again, we've got you can see we had a nice bounce off a low here. It has showed strength, and it's showing relative strength over the last 2 days when the market is falling apart, right? Drawing a bit of a bull flag. You know what to do on the bull flag. We've drawn our target in there, and that is about $12. That does correspond with a little bit of a level here. We've seen some price action in that area. Again, this needs the market to help it. I really don't want to be jumping in a breakout here if the market isn't helping. And if I did go into this, I'm going to put it on a super short leash. Because, in this market environment, if things roll over, you can see what happens. You get these giant red bars, and this is a very volatile stock as well. Look at this. The average true range, 10%. That's huge, right? So, yeah, you've got to be careful. Play it small. And with your stop in here is pretty obvious, right? Somewhere under here or under here. But yeah, this looks like it could go, but not with the market doing what it's doing. I see that the futures have just opened. Let's take a quick look at that because they are quite red. They are down over 0.5%. Here is today's candle. The futures candle is right here. Because you can see that they are gapping down in after, or I guess pre-market trading. I'm not sure what they call it in the futures, but we are, we do have a gap down here. It's kind of red. If we look at an intraday chart on this, you can see this a little better here. So here's where the futures closed on Friday, is up here, and we gap down, and we are flirting with, I'm pretty sure that, yeah, that's the low right there. Oops, what happened there? That is the low from Friday, and we are currently below that, so that's not good. However, all sorts of weird stuff happens in the futures when they open. They put in moves like this all the time and then reverse and go higher. It's much too early to put too much weight on what is going on here, but it is something to be aware of for tomorrow. What else? I think that's about it. China reopens tomorrow. China's been closed for a week. I'm pretty sure they reopen tomorrow. They've been closed for a week they've got a week-long holiday, National Day holiday. And those markets should open, so that should be interesting. And that is something, if China, if China is strong in the face of everything we've been seeing going on around the world, that could bring our markets up. And you can see right now we've got a little bit of a green shoot forming here in the futures. So we'll leave you with that. I want to thank everybody for watching all the way to the end here. Go ahead and hit that like button if you've enjoyed what we've had to say, or if you found this educational. And as always, we'll take a look at our calendar. Coming up, we've got mentor sessions every Wednesday. Mentor sessions through Ticker Talks every Wednesday through the rest of the month, and of course our weekend videos. I might change one of these a little later into the month. I might change one of these to an educational session, or maybe a really quick Ticker Talk and then a little bit of educational along with it as well. So hope to see you all in the Discord, and enjoy the rest of your weekend. Thanks, everybody.